Good morning, and thank you for joining us on the program. I am Bisi Adebayo. On Tuesday, the federal government made a projection that the country's foreign debt stock will hit 32.5 trillion naira by December the 31st, 2020, and 38.68 trillion by December the 31st, 2021. The Minister of Finance, Zainab Ahmed, who made this known while appearing before the Senate Committee of Local and Foreign Debt, says the nation's debt stands at 31.01 trillion naira as at June the 30th, 2020. Let's take a listen.
New borrowing that was provided for in the 2020 Revised Appropriation Act was 4.198 trillion naira as new borrowing to finance the budget. So this is 4.198 trillion naira. When you have a comma and a point, it's the same thing as trillion. The status of the implementation of the borrowing in the 2020 budget for both domestic and external is shown in Table 3. So for the new domestic borrowing, the appropriation was 2.213 trillion, and the actual between January to October to 23rd of October, I beg your pardon, is 2.188 trillion, representing 98.88%. On the other hand, the new external borrowing, which was appropriated at 1.984 trillion naira, the actual is 1.224 trillion naira, representing 61.64%. So the new domestic borrowing included 162.56 billion naira for the Sukuk, which was issued in June 2020. The balance of 25 billion will still be raised between November and December 2020. That's the domestic borrowing. This amount represents, there's also included in the external borrowing is the $3.4 billion that has been provided by the IMF to Nigeria as a loan, and the IMF has disbursed this facility. We're still working with the World Bank and the African Development Bank and the Islamic Development Bank towards the disbursement of the facilities from the banks. For the AFDB, the bank has approved the facility, and we are in the process of meeting the conditions for disbursement. In the 2021 budget proposal, the appropriation bill provides for new borrowing of 4.281 trillion naira. The new borrowing is broken down equally between domestic and external borrowing, and that is shown on the table, on Table 5. The share of the deficit to be funded by borrowing is 95.43%. The other financing items is revenues that will be coming in as financing items on the proceeds of privatization.
And that brings us to our conversation now, and I have with me an economist and senior lecturer at the Lagos Business School, Dr. Bongo Adi, to talk about the impact of the debt stock on the country's economy. Good morning, Dr. Adi. Thank you for joining us on the program. I'd like to begin with getting your reaction to the federal government's latest request for an external borrowing of $1.2 billion from Brazil to finance agricultural programs in the 2021 budget.
Well, good morning, by the way. Well, it is not new, this whole issue of borrowing on top of, previous ones. So that is where we have found ourselves, because definitely we're, strapped of critical resources to fund the economy. All right, especially in the wake of COVID-19 and the impact, the devastating impact it had on oil price, which is more than 90% of our, government or public sector revenue. So what it means is that we do not have much choice or options when it comes to resourcing or funding. So the only thing that we have to do But I mean, that is from the perspective of government. So their option seems to be to borrow. So they've been doing that. So I do not see anything untoward if they go ahead to borrow another tranche of funds from Brazil. But what we need to worry about is the capacity the country has to repay. Because right now, of course, you followed the debate some time ago, about 2 months ago, when the Nigeria Economic Summit sent out a note of warning, the kind of an alarm. They rang the alarm bell that Nigeria's debt was becoming hugely unsustainable, and that hasn't changed. So rather than government taking some measures to change that reality, but it seems to be going deeper and deeper into more borrowing. So the news seems to be tightened by the day. So. And that is where we find ourselves. But is that the only option that Nigeria should be exploring at this point in time? Of course, the answer is a clear no.
So what other options should Nigeria actually be looking at?
Okay, I don't know if you've been following the news. So some months ago, PwC actually published a note where they talked about the debt capital. What Nigeria could do to bring or resuscitate debt capital, bring debt capital back to life. Nigeria is sitting on top of more than $900 billion of debt assets in real estate and in agriculture that needs to be, cleaned up and, recapitalized. Of course, we understand that. We also understand the role of equity. Actually, the problem that Nigeria has is an investment problem. Of course, we have a debt problem, but that problem or the debt trap, whatever you call it, will fail, when you consider the investment problem, and that is the source of the current challenge that we're having, with our revenue. Supposing that we have the right investment climate, we have the conducive investment environment. Of course, we will not sweat the small stuff because investors. There used to be a time when Nigeria was the prime attraction for foreign direct investment, but that is no more the situation. Okay, so we need to ask ourselves the hard questions regarding what has changed. Why do investors no longer finding us attractive as an investment destination? So why has investors kind of started to run away from our country? Of course, the reasons are obvious to everybody. Even the youth, when they went on street the other day, we know what their demands were. So we understand the situation. In fact, it's actually, I think Nigeria will be lucky if any country is willing to lend money to it right now, because given the operating environment, it will be hard to convince any foreign investor to bring money to Nigeria.
Now, some have argued that these borrowings are necessary given the fall in oil revenues and the huge infrastructural deficit needed to propel economic growth. And then others also believe that the increase in the external debt makes the Nigerian economy vulnerable to external shocks. What side of the divide do you belong?
I do not belong to any of those sides. I won't take any sides because those options are not actually on the table for me. I believe strongly that there are some reforms that we need to undertake. Of course, we've started on that path. The reform in the oil and gas sector, the deregulation that's been long coming, that we're now beginning to see, although the impact is yet to be felt. And of course, the foreign exchange market, where it seems that we make one step forward and then two steps backward when it comes to the foreign exchange market. So if we can fully deregulate this, the economy, I think that we will create the right signal. We will give the right signal to investors that really committed to doing business. So I think that is the most important thing. But beyond that, security is another major concern. Okay, so it's not just about how much we borrow, because if we do not get our acts together when it comes to security, so we will still be ramping up debt, but not having the capacity to repay, okay, to service our debt obligation, because that's the critical thing. So right now, our debt service obligation is rising, and revenue to debt service has increased to, some people argue that it's about 99%, though dropped to 70%, but I think it's also because with new borrowing, so it's not. That means all the revenue that government makes is used for debt servicing. So that doesn't spell well for the economy anywhere you look at it. So for me, I think that we need to readjust, reform the economy. So there are so many things that we need to do. I was just speaking about the debt capital that is still trapped in Nigeria that we need to find a way to bring back to life. Okay, we need to create the right environment for investors, even domestic investors. Some Nigerians got money and they're interested in investing, but the incentives are not just right. So that is what we see on a daily basis. And again, I think why we are going the way of borrowing is because the government is fixated on being the sole provider, the sole supplier, of everything. So should government be the sole provider? Of course, the only reason why that seems to be rational now is because of the level of insecurity in the country. Now, think of what happened just the past few days. The little infrastructure that we had, went up in flames overnight, okay? So we're not able to protect even critical infrastructure assets. So if you were to bring in the private sector, supposing that it was the private sector that owned all those.
All right. We seem to have lost Dr. Bongwadi there, but we'll hope to reconnect with him in just a moment. But let's just touch base with the crude oil markets quickly. Oil prices were down earlier today as Democrat Joe Biden edged closer to the White House in a nail-biting U.S. presidential election. But the Republicans look likely to retain Senate control, decreasing the chances of any huge COVID-19 relief package. Brent crude dropped 1.65% to $40.55 a barrel, while U.S. WTI futures were down 1.63% to $38.51 a barrel, and both contracts had jumped around 4% on Wednesday. All right, we have Dr. Bongo Adi back with us. All right, okay. We're still trying to fix that, but let's just continue with updates from the crude oil markets. Now, we know that vote counting and trends suggest that Republicans appear poised to retain control of the U.S. Senate, and Democrats will hold a slim majority in the White House, or in the House of Representatives, rather. A divided Congress would likely prevent Biden from enacting major priorities like fighting climate change or easing sanctions on oil producer Iran. We have our eyes on all these developments and we'll see how they impact on all the markets. And of course, we'll be talking more about that on the commodities update segment in just a moment. But once again, let's just do a recap of where oil prices are as at this morning. We have Brent crude down 1.65% at $40.55 a barrel, and U.S. crude is down 1.63% at $38.51 a barrel. All right, Dr. Bongo Adi is back with us now to continue the conversation. So let's just get right to it. Thank you for sticking with us, Dr. Adi. I hope that the connection is much better now. Now, Nigeria is not alone in experiencing escalating levels of government domestic indebtedness, but when you compare to other sub-Saharan countries, Nigeria's domestic debt GDP ratio is clearly on the high side. What are the implications of this?
Okay, of course, the implications are quite dreary, to say the least. First of all, as our level of indebtedness keeps deepening, what you're going to see is, the rating agencies will come after us. Of course, will be downgraded. We're seeing that already happening. And that's also, once you get downgraded, then that limits your capacity or your ability to even raise more money, borrow more in the international capital market, in the international financial market, because that's the way it works. Okay, so that means the risk, keeps escalating and piling against us. So that is, what we'll be seeing. And again, we also need to be concerned about the judicious utilization of the funds, how the funds are deployed. Are they effective and are they efficiently employed? Because if that is not the case, so we will have, just amassing debt without the necessary capacity, because if they are not fungible in the sense that the debts are not translated into infrastructure that will now activate productivity such that there will be funds available to repay the loans. So if that's not the case, so we just have, the negative side of it without having any positive. So that, of course, will worsen the economic situation. It has impact on dampening the growth. Again, government having, because the debts are usually, once they come, they have some priority sectors where those things are put in. So we do not have resources for other sectors. So the level of poverty and underdevelopment and lack of growth will continue to worsen. So the impacts are, of course, obvious for anybody to see.
But while we'll talk about the impacts now, the federal government has developed a financing strategy to attract private sector investment in bridging the infrastructure deficit through several tax credit schemes. How well do you think this strategy will attract more investors towards infrastructure development?
If that were to be the solution or the panacea, of course, I think government would reduce its borrowing tendency. But from things, government doesn't even put much trust in that scheme. Why? Because first you need to get the security situation under control. Right now it is not, and security is the key to peace. Is a precondition for development to happen. So if you don't have that, if you don't have security, you do not expect the investors to warm up to all the incentives that you are giving, no matter how attractive, no matter how good they may appear to be. So what is important here is security of investment. So right now, Nigeria displayed or manifested this lack of capacity to really protect investment. And I think that is the key thing that we need to work on. So how do we, get our security architecture right such that investments can be protected? Because that is the first precondition. That is what any investor, whether local or international, whether domestic or foreign, the first thing they need to look at is the safety of their investment. Can they recoup their investment when they make it? So, but as it is right now, everybody knows the level of insecurity in Nigeria. So that itself is a great distemper to any sort of investment.
Now, what's your assessment of the loans that have been obtained so far by the current administration? Would you say they are actually being put to good use?
Well, if we look at the power sector, for instance, for the first time, we've recorded, about 5,000 or more megawatts of electricity, in our history. So that is actually a great achievement. So if we now consider the loans that have been put in the power sector, so you can see that, okay, they have become fungible, they have been converted. So the convertibility is there for everyone to see. So we can see the impact in terms of improved power supply. So if we're looking at the road network, there's also some improvement in road network, yes. So, and in other sectors, but we're also seeing where, for instance, if you look at agriculture, despite the amount of money that's been put in agriculture, so we're seeing that the agricultural contribution to GDP is actually beginning to drop. There was a time in 2015, 2016 that agriculture, even during the recession, whereas other sectors went into recession, agriculture did not go into recession. But we've seen that agriculture has actually started to lose momentum. So despite all the infusion of funds through different schemes by the central bank and all of that, so even new loans are still coming into agriculture. So we are not yet, and then look at the food price, okay, in the market. So we're not able to feed ourselves. That is why food inflation is hitting the roof. So yes, there are some positive achievement in some sectors, but in some other sectors, a lot more needs to be seen.
I'd like to thank you, economist and senior lecturer at the Lagos Business School, Dr. Bungo Adi. Thank you for sharing some of your thoughts with us this morning.
Thank you very much.
We'll turn our attention to the commodities markets when we return in just a moment. You stay with us. The head of research at the financial derivatives company, Damilola Akibami, joins us now to discuss the latest burning economic issues at the domestic commodities market. Good morning, Damilola. Thank you for coming on the program.
Good morning, BC. Thank you for having me.
All right, let's start off with oil prices. Now, they appear to be finding some balance around $40 per barrel on tight U.S. election voting results and a weaker dollar. How comfortable should Nigeria be with this latest development?
Oh, well, like rightly said, the U.S. elections, right, and the votes that have been counted, it's still very tight, and we can't call who is going to win yet. But for Nigeria, we're a price taker, so definitely would benefit if all prices increase. But the fundamentals are still the same. So irrespective of the win, whether it's a Biden or a Trump win, both have their pros and cons for the oil market. So Nigeria stands to benefit from higher oil prices. But if you look at the fundamentals, with the oversaturated market, with demand still being weak, oil prices are still going to remain bearish in the near term.
All right, now let's switch to the IMF, which has commenced its Article 4 review for Nigeria. What fillers are we getting from that?
Oh, well, typically the IMF review, Article 4 review, is when a staff team from the IMF meets with government officials to look at the economy. So they review the macroeconomic state of the economy, discuss policy issues, identify vulnerabilities that are inherent and what policy actions have been taken and whether they are sufficient. And we know that typically they will make recommendations, and some of the recommendations of the IMF in the past, previous reviews include having a unified exchange rate, adopting a flexible exchange rate regime, tightening interest rates to rein in inflation and attract capital flows, and also basically adopting, for instance, a cost-reflective tariff. So sometimes these recommendations are unpopular with the government, but at least it gives you a sense of what to expect or how the international market is viewing the economy. So that is what we're going to say. And it's still too early to tell, but definitely we all know what is going on in the economy. We don't need any outsider to tell us what is happening. But it's more importantly, the recommendations that are most likely going to be made available, are they going to be adopted or not? So it will be interesting to see what the outcome is.
Fingers crossed, and we'll wait to see what the outcome will be. But let's talk about the World Bank's forecast of a drop in Nigeria's diaspora remittance inflows to $21.7 billion in 2020. Is it all about the COVID-19 pandemic?
Yes, it's partly because of COVID, or that is the main reason. So because of COVID, we've seen that the global economic growth has been really dampened, and it's weak right now. And we've also seen that a lot of companies have laid off staff, they've cut salaries just to make ends meet. So employment levels are down globally. And diaspora remittances are the funds sent home by Nigerians working abroad, living abroad, which has been sent home. And these funds actually contribute to the external reserves of the country and also boost household income. So for Nigeria, for instance, which is the largest recipient of diaspora remittances in Africa, it's a big deal, this decline. And what we're going to see is that if the Forex supply, because like I mentioned, it contributes to the external reserves. So if Forex inflows are declining amid the demand that is most likely going to pick up as at least economic activities resume and increase, you're going to see that increase and pressure on the external reserves. And obviously, if there's a depletion in the external reserves, which we're seeing now, which is down to $35.6 billion, the ability of the CBN to actually support the currency to maintain its frequent intervention becomes constrained, and then you begin to see more exchange rate volatility. And for the average Nigerian, that depends on the funds remitted home from Nigerians in diaspora. Because of that decline, obviously, we know that almost everybody, in a way, in real terms, everyone has received like a pay cut in real terms because of the exchange rate adjustment. And some of these Nigerians actually depend on the funds sent home. So because of that decline, they're obviously going to face more challenging times. So it is actually a major issue for Nigeria.
Let's dwell more on the currency. Of course, the Naira is seen comfortable at around weekend at around 464 to the dollar at the parallel market.
Yeah, so what is driving that right now, like I mentioned earlier, is the pickup in demand with the resumption of schools, more businesses operating, international flights also have commenced. So we're definitely beginning to see the demand pressure. The CBN is still intervening in the Forex market, at the retail market, and still selling to BDCs. But because the supply is not coming in as much as the demand that is present, so that pressure is still going to be felt on the exchange rate. And we might see maybe another adjustment down the line if this trend continues.
Now, I just talked about this, that's talking about Nigeria's debt profile with my previous guest, Dr. Bongo Adi, but I'd like to get your reaction, talking about the prediction from the finance minister that the country's total debt stock will reach 38.68 trillion naira in 2021. Could we possibly be headed for a debt crisis?
Well, that is a risk that could occur because right now Nigeria has a very high debt service issue because that is one indicator that a lot of analysts actually use to evaluate the debt sustainability of any country. If you use the debt to GDP, it doesn't give you a true picture because, for instance, Nigeria's debt to GDP ratio is below 30%. Meanwhile, as at the end of the first quarter of 2020, the debt service to revenue ratio was 99%, meaning almost all that was earned was used to service debt, meaning there was really nothing left to actually fund all these capital projects. And the main issue there is that when it's time to refund or to pay back this debt, the interest rate, because right now interest rates are low, both in Nigeria and even globally. When the economy starts to recover, when interest rates start to increase, it becomes more expensive to service this debt. And if right now we're having a 99% debt service to revenue ratio, compared to what the World Bank IMF's debt sustainability framework for low-income countries, which is about 23% to 99. That is huge. And investors are looking at that indicator. And they have a sense that, oh, this country runs the risk of falling into a debt trap, then it could lead to a revision, a downgrade of the credit rating. And if the credit rating of a country is downgraded, it makes the country more difficult. It makes it more difficult for the country to actually access international funds because your debt instruments become more expensive. And we know in October, Fitch actually upgraded the country's outlook from negative to stable. But then still, because of low oil revenues and Nigeria depends highly on this commodity, if that continues and the external imbalances deteriorate further, we stand the risk of having our credit rating being downgraded.
Or what if the oil prices actually go up?
Well, that is a good thing. So, like, for instance, in October, they actually upgraded our outlook. If economic balances improve, the macroeconomic performance improves, all prices increase, we have a wider revenue base, we have an increase in VAT revenue, our exchange rate policy is more stable. Definitely, it would impact positively because then investors are more confident and that would reflect in the credit rating.
Now, let's talk about commodity prices. Now, where are we in terms of commodity pricing? And then also, let's talk about Lagos at risk of a second lockdown. What are the implications of all of this on the commodities?
Well, commodity prices right now, at least domestic commodities, are actually being affected by supply chain challenges, and that is why we're seeing commodity prices still high at this time of the year. And like you mentioned earlier, also Lagos stands the risk of another COVID surge, especially following the EndSARS protests, which involved obviously huge gatherings, and most people obviously were not wearing their masks. So that risk is very potent. And if that occurs and another lockdown is imposed, or maybe even the positional lockdowns where you have certain areas in Lagos being closed, it would impact on the business and economic activity level of the state. And bear in mind that Lagos is the commercial hub of the country. So whatever happens to that state will affect the overall economy. So it's a major risk, and everyone needs to be socially responsible and endeavor to adopt the restriction measures and at least endeavor to wear their masks when they're out.
Thank you, Damilola Akibami, Head of Research at the FDC. Thank you for coming on the program.
Thank you, BC.
Now, let's change our conversation now. Choice International, under the leadership of an accomplished industrialist and entrepreneur, is introducing the Gree and Lonta franchise retail opportunity to Nigeria's investment community. The franchise opportunity is for two brands, Lonta, known for their rechargeable products, and Gree products, which are the cooling systems brand. According to the brand owner, under the franchise offering, investors have been assured of over 35% return on their investment. Let's see the report.
Lonta and Gree are two products representing brands in the cooling business and rechargeable space, not new to the Nigerian market. This meeting is a call to an investment opportunity by way of Gree and Lonta franchise.
With over 100 unique products on display, the Gree and Lonta retail brand shops have recorded remarkable turnover and profitability over the past years. with yields of an average investment and ROI of over 50%.
Two strategic value proposition is up for offer. You can be one of the 6 major regional logistics centers franchisee across the political zones, or the branch shop owner for retailers, all with exciting return on investment.
With an initial capital outlay of $1 million, a warehouse and distribution trucks to do milk runs, you can own any of the logistics centers in any of the regions of this country. So 20 million naira, you have a store, 150 to 200 square meters. You can access 15 million naira credit facility based on your initial deposit to stock up your store. There is a minimum turnover of six. You can turn over your principal 6 times in a year.
It is not just a business offering according to the proponents. It's an initiative to help rebuild the economy on the back of 2 quality brands.
The confidence can be shown today that we still want to call for more people to be back to their normal business. At the same time, we also show our partnership spirit that we come here to do business and we come here to look for our business partners. So let us work together, unite together to rebuild the economy of the countries.
The main thing for me is the quality, because as a business, you can't be buying items and then having to change them, after a year or 6 months and so on.
There's more. Management says your income line are not limited to buying and selling, because the stores will be built into service centers, which gives you opportunity to earn more from being a service provider on technical and maintenance under the Cool Man program.
Now let's get a review of yesterday's equity market activities from Eddie Diong Ewan. Good morning, Eddie.
Good morning, BC. Well, the market was positive yesterday, but then it gained marginally by 0.03%, and that was due to some gains from a few banking stocks. The all-share index was up 0.03% at 30,741.88 points, while the equity cap was at 16.068 trillion. Activity level was lower yesterday compared to previous sessions, as we saw 286.44 million units. Now, that was about 40% lower than what was traded on Tuesday. Volume also declined by about 34% to 3.09 billion naira, and all of that was traded in 2,899 deals. Now, looking at the sector chart, we wonder why we didn't see much gains, because all the sectors are green apart from the banking index. Now, for the banking index, we saw gains from GT Bank, FCMB, and Fidelity Bank. GT Bank gained yesterday. The bank notified the NSC that it had gotten approval in principle from the CBN to begin the process of reorganizing the bank to a financial holding company. So maybe that was why investors, reacted to that. Consumer goods was up, and then all the other sectors were up. But let's talk to Abdul Rashid Momo, a stockbroker at TRW Stockbrokers. Good morning, Mr. Momo. Thank you for joining us on the program. So yesterday, we saw a lot less activity in the market compared to previous trading sessions. Why was that? What was responsible for that?
Okay, you see, the market, we have 2 players in the market, right? We have the investors and we have traders. So if you look at market trends all this while, market have been going up. And in terms of the technical analysis, most of these stocks are hitting resistant levels. So for traders, they found areas to take profit. And I've said, when markets trend like this, if anything that goes up, there will be a time of rest. So that's what's happening for now. But what I'll tell people is that this bull rally has not ended. Any investor buying now, they are buying on the information that we still have a year end, which is coming up. Example, people like GTB, Delhi, GTB, they are still going to be at least another final dividend about 2.50 kobo, give or take.
So even at this current price of 21 naira, if you look at it, that's more than 10%, which no money market instrument can give you till date. So the market is still attractive, but what we are seeing now is just people taking profit, which are the traders. The investors are still more in the market. So that's it.
Yesterday, GT Bank notified the NSE that he had gotten approval in principle from the Central Bank of Nigeria to reorganize the bank to a financial holding company. It also said it had gotten a no objection from the Securities and Exchange Commission. What will this reorganization or restructuring mean for shareholders, and how will that affect the bank's standing in the market?
I wouldn't know more about that, but I know.
Guess we've lost Mr. Momo there. Well, hopefully we'll get back to him to know how that, new development is going to affect the shares of GT Bank. Although reading through the communique sent to the NSE, the bank said the restructuring process will involve a switch of one share to one share. So whatever switch is going to be made, I don't think investors will really lose out on their investment. So back to the markets now. Consumer goods was up 0.05%, and that was due to gains from Dangote Sugar. Industrial goods was up 0.03%, and that was single-handedly lifted by Lafarge Africa. Insurance was up 1.04%, while oil and gas gained 0.35%. Although we didn't see much changes in the oil and gas sector, the unlisted securities market, finally, we saw some gains in that market yesterday. BC, the market was up 0.81% at 720.69 points, while the market cap was at 529.39 billion naira. We saw just about 5,877 deals worth 795,492 naira, and all of that was traded in 4 deals, BC. But just like Mr. Momo said, it's still a bullish market, so we don't expect, anything to change. Well, I hear Mr. Momo is back. Good morning, Mr. Momo. Thank you for connecting with us again. You were saying something about the notification of GT Bank. How will that affect the bank's standing in the market?
The funny thing, everything you've asked me, I've answered the question in terms of there are 2 players, right? Even as of now, we have more offers of than bid in the market, but it's still not going down, because even with the information on ground, people are still buying into the stock, awaiting the final dividend which are going to play. Despite all this information, we still have people still going into that stock. Normally, if the information was negative for GTB, the price would have been down by now, but it's still within the price range we've been discussing about, just light corrections. So as I said, the market is still going to be bullish. I need to go into more technical details. What they call Elliott wave, the market is in a wave 3, and wave 3 is a very long bull trend, where you take profit, you think you've taken profit, and the price keeps going up. So that's what we are seeing now. When the long wave of wave 3, Elliott wave, wave 4 acts as correction before the final wave. And December period is always the best time to actually enter the market because of year-end financials. So for me, despite the information on the GTB, it's still a good buy.
Okay, so apart from earnings now, what other major catalysts do you think the market needs at this point, or could drive sentiment even further in the market?
As I said, what drives market is most of the players in Nigeria, they love what they call dividends. Dividends is always key. And we are approaching that to the year end, which takes the market into the March, May, June, before we start seeing the major corrections. Because market has a cycle, and our market, normally from June, we start seeing a downward trend. So within this period, despite the fact that the market is up, the market has been up for most part of the month, the dividend is still going to drive the market up, because we are actually approaching year end, which is next month. So that's the main thing that's still going to hold this bull trend. Yes, we are going to see corrections, but the market made a new high yesterday, and we'll keep making those new. We are going to be making higher highs. in months to come, because the market has suffered for too long. And with the money market, low interest rates and the rest, it has given the stock market the catalyst to actually drive what we are saying now. I mean, that's what we are seeing now. The reduction in rates in the money market was driving the stock market now.
All right, Mr. Momo, thank you for your input on the program. Abdurrashid Momo is a stockbroker at TRW Stockbrokers. Well, BC, just like Mr. Momo said, I think you and I should be getting set to take position
I was
in
just
the
saying
market.
that these are certainly happy times for investors at the stock market.
Absolutely.
We'll see if we'll take that opportunity. Of course, we'll get back to you when we return shortly. And that will be right after we make an opening call to London. Just stay with us. The new 4-week lockdown begins today in England. Well, let's bring in Juliana Olayinka to tell us how that is coming up. Good morning, Juliana. Well, just before you tell us how that is coming up, we just got news that the BOE has maintained rates. Could you just touch up a bit on that?
Right, okay. I'm not sure because, of course, I've been sitting in the studio, but from before coming into the studio, I know the Bank of England did say that they would be extending their quantitative easing to £150 billion. I think prior to this, it was at £700 billion. But, of course, they are keen to pump as much stimulus as they can into the British economy because we were already struggling. I believe lots of the data we were getting out of the PMI figures did suggest already that this kind of V-shaped recovery that many economists here had hoped was fading fast. Data that we're getting from all of the sectors, including services, manufacturing and construction, are being forecast down. We know the OECD have already said that Britain are on course to losing between 10 and 11% of their GDP this year. And this was before Prime Minister Boris Johnson even announced this second national lockdown. So no surprises that the Bank of England have injected £150 billion into the economy. But interest rates still remain the same if that's what has happened at 0.01%, which is already historically low, which already makes it difficult for British banks to bring up their profitability margins, which is one of the reasons why loans are so difficult to attain here in Britain today.
All right, now, so tell us how everyone is adjusting to the new lockdown, which kicks off today in England.
It's difficult to really say because, of course, it's still pretty early here. We're on GMT time, so we're running 1 hour behind Nigeria. But when I got off the tube this morning, when I was on my commute, it was a little less packed. It didn't feel as deserted as it did back in March, which was a completely different atmosphere. Of course, we know that children are still in school, so the school runs are still taking place. A lot of coffee shops that weren't open during the first lockdown are still open at the moment. So things are moving, but of course they're not moving as fast as some people would like. Last night was called Lockdown Eve, even despite of the historic scenes we're seeing stateside. Lockdown or cancel lockdown was still trending on social media, and it does appear that there is a vast quantity of people in Britain and England that are not happy with these restrictions. They think they're going too far. That's even though yesterday we did record 492 deaths of COVID-19 in this country. That's the highest death rate we've actually had since the 19th of May. So clearly we can see that we are in the midst of this second wave. And I believe yesterday afternoon as well, the NHS rose their alert level to the highest alert level, which does mean that hospitals up and down this country are starting to become overwhelmed with the amount of COVID cases that they're seeing. But I think, according to what we're seeing on social media and according to reports that are coming from the government, it's whether or not people are going to be sticking to the restrictions. We saw lots of rules being flouted over the past couple of months. Are people going to maintain these social distancing rules? Are people going to stay away from the office? Are people going to stick to their bubbles? That is going to be the big test to decide whether or not Britain can emerge out of this 4-week lockdown on December the 2nd, or, as some critics and some are suggesting, it will be extended into the new year.
Which is what many don't want now. The British Retail Consortium is warning that any extension to the lockdown could be catastrophic for struggling retailers who risk losing billions of pounds in Christmas sales. Of course, this is not the first time we're talking about this, but what about switching to online sales? Won't that help in any way?
Well, it will help, but surely we definitely cannot compare online shopping to shopping when you're shopping in the store. I think that there's a huge difference in that, isn't it? And we've seen that because retailers have still struggled, even though e-commerce has leapt in leaps and bounds, particularly Amazon. And I think this is where the British Retail Consortium, especially their chief executive, Helen Dickinson, that she's really concerned about the independent stores. There are a lot of independent stores that are pretty unique. You know, you can't get their items on places like Amazon or online stores. They rely and they heavily depend upon people walking into their stores, touching, feeling. I'm sure you do it, Bissy. I do it sometimes. You're going for one thing, you come out with 5 other things. That is exactly what retailers expect in the run-up to Christmas, the 4 weeks to Christmas, just after payday. Everybody is supposed to be going out, spending their money, buying for loved ones. And the way retailers top up in the golden quarter is for people buying things that they don't necessarily need. When you shop online, you don't do that. You know exactly what you want, and you usually only buy one item. So those are the concerns that British retailers and the British Retail Consortium have this morning.
Well, then that just helps us to save money, not, buying what you don't need. Anyway, thank you, Juliana. We'll see you again much later. And it's back to Eddie to take us through the debt and currencies market. Over to you.
Thank you, B. So the bond market was bullish yesterday as yields declined by about 25 basis points. Now, we saw declines at the long and the short end of the curve due to interest in the January 2026 and the March 2050 bond. On that counter, we had 32 deals yesterday worth 31.32 billion naira. The Treasury bills market was quiet yesterday. It was mute, actually. Average yield stayed flat at 0.5%. But then we saw some interest and some slight changes in the 28th of October 2021 maturity. This reduced to about 0.65%. It reduced from 0.65% to 0.40%. We had 11 deals worth 35.90 billion naira on that counter. But let's talk to Babajide Solanke, a fixed income dealer at FSDH Merchant Bank. Good morning, Babajide. Thank you for joining us on the program.
Good morning, Eddie John. Thanks for having me.
So it seemed like trading at both the bond market and the Treasury bills market was quiet yesterday. Is it as a result of excess liquidity in the system, or what was responsible for that?
The Treasury bill market was a bit active. It wasn't as active as we would have expected, given the liquidity in the system. If you remember on Tuesday this week, the central bank injected about 224 billion naira into the system by on the maturity, and that has found its way in terms of people trying to take advantage of opportunities in the Treasury bills market. But again, you must understand that the existing rate in the Treasury bills market, on the secondary market, is actually sub 1%, which, of course, hardly any income or profit to be made in terms of the thinning margin. So that's why you saw a bit of a loss, despite the high liquidity level in the system. However, the central bank today has given out the notice of any auction across 10 of about 90 billion. So we expect about 134 billion to remain in the system, even after the central bank completes its promo auction for today. For the bond market, it's been quiet. The same way, the rates existing at the spot week and the long end of the curve in the bond market, the rates are low, the liquidity low, and taking positions in at those low rates are quite risky for traders and risky for people that want to invest, because then you can just change along the trajectory. They're locked into a very low rate, and and things can go bad, and the significant losses to be made. So people are just being cautious in terms of the low rate existing in the market and the thin margins, basically.
All right, Babajide, thank you for that. We'll keep watching that space. Enjoy the rest of your day. Babajide Solanke is a fixed income dealer at FSDH Merchants Bank. We'll have to leave it there on the market review for today. Over to you, BC.
Thank you, Edith Young. Tomorrow is another day to do more review. And that's our program today. Thank you for watching. I am BC Adebayo.